What if I told you the most profound insights into navigating today's markets? The crypto bubbles, the meme stock frenzies, the 24/7 chaos don't come from a new trading algorithm or a Silicon Valley guru. What if I told you they come from a series of conversations held over 35 years ago, before the internet put a stock ticker in every pocket, before Reddit forums could send forgotten companies' stock to the moon, before AI could execute trades in the blink of an eye, a time when charts were drawn by hand and the fastest news came from a ticker tape machine? It sounds impossible, doesn't it? How could the wisdom of traders from the era of landline phones and floppy disks possibly be our guide through the digital whirlwind of modern finance? How could a group of people who never heard of Dogecoin, never saw a SPAC, and never experienced a FOMO of a Robinhood notification teach you more about survival and success than any influencer on social media? The answer is simple. Because while the technology, the assets, and the speed of the market have transformed beyond recognition, the one thing that truly drives it all has not changed one bit: human psychology. Fear, greed, hope, and despair. These are the eternal forces that power the market's engine. They are the currents that pull fortunes in one direction and drag them to the depths in another. And learning to master these forces within yourself is the one true secret to success. This was a discovery made by Jack Schwager, a humble analyst who embarked on a quest to find and interview the world's most elite, secretive, and successful traders, the market wizards. Welcome to Capitura. Today, we are not just reviewing a book. We are sitting down with legends. We are taking an audiobook-style journey into one of the most important trading books ever written. Market Wizards, interviews with top traders by Jack D. Schwager. This is not a simple summary. This is an extraction of timeless mental models for winning a game that is designed to make most people lose. We will unpack the strategies, the psychology, and the hard-won lessons of men who turn small stakes into vast fortunes, not by finding a magic formula, but by achieving a level of discipline and self-awareness that is almost superhuman. Stay with us, because the principles discovered in this book are the bedrock upon which trading empires have been built. They are the shield that will protect you from the financial noise of our time, and the compass that will guide you toward true financial intelligence. Introduction: the sorcerers of the trading world. Jack Schwager wasn't a wizard himself. He was a curious and brilliant researcher, a director of futures research at a major Wall Street firm in the 1980s. He had seen thousands of traders try and fail. He had seen countless systems and strategies blow up, yet he knew there was a small, elite group of traders who consistently pulled astonishing returns out of the markets year after year. They were spoken of in whispers, their results so far beyond the norm that they seemed to defy logic. They were the market sorcerers, the wizards. Schwager's brilliant idea was this: what if he could get these people to talk? What if he could sit down with them, one-on-one, and uncover their secrets? Not just their methods, but their mindset. How did they think? How did they handle losing? What did they learn from their biggest mistakes? He embarked on a mission, using his industry connections to get a foot in the door with these reclusive masters of the financial universe. The result, first published in 1989, was Market Wizards. The book was a phenomenon because it did something no one had ever done before. It revealed that there was no single holy grail. The wizards he interviewed were wildly different. There were pure technical traders who believed all that mattered was the price on the chart. There were deep fundamental analysts who spent months studying global supply chains. There were quants who built computerized systems and intuitive feel traders who operated on instinct honed over decades. They traded different markets, had different time horizons, and used completely different tools. Yet, as Schwager peeled back the layers, he discovered a set of common threads, a core of underlying principles that every single one of them shared. These principles had nothing to do with a specific indicator or strategy, and everything to do with risk, discipline, and psychology. So why does this book matter now, in the age of algorithmic trading and decentralized finance? It matters more than ever. Think about the modern investing landscape. You open an app like Robinhood, and it's designed to feel like a game. It encourages you to trade, to be active, to chase what's hot. This is a world of FOMO, the fear of missing out. It triggers our most primal instincts to chase the herd, often leading us to buy high in a frenzy and sell low in a panic. The market wizards offer the antidote, a ruthless focus on a predefined plan, and, most importantly, on risk management. Consider the hype around a stock like Tesla. The story is incredible, the leader is a visionary, and the supporters are passionate. This narrative can pull you in, making you feel that valuation doesn't matter. The wizards would teach you to separate the story from the trade. They would force you to ask, where's my entry point? Where's my exit if I'm wrong? How much am I willing to lose to find out if I'm right? What about the world of cryptocurrencies like Bitcoin and Ethereum? These are assets that experience volatility, the likes of which many of the original wizards had never seen. Yet, their principles are a perfect fit. The core idea of cutting losses quickly and letting winners run is the very essence of surviving and thriving in the crypto market. Without the discipline preached by these traders, the crypto world is little more than a high-tech casino. Even for those on a more stable path, like the FIRE movement, financial independence, retire early, the wisdom here is indispensable. While FIRE is often built on passive investing in low-cost ETFs, the psychological challenges are the same. What do you do when your ETF portfolio is down 30% in a bear market? The temptation to sell, to abandon the plan, is immense. The mental fortitude and long-term perspective of the wizards, even the short-term traders, provide the psychological armor needed to stick with a sound strategy when it feels the most difficult. Market Wizards is not a rule book. It's a mind-altering substance. It's a collection of conversations that rewire your brain to think about markets not as a path to easy riches, but as a strategic and psychological battlefield. It teaches you that success doesn't come from having a high IQ or a secret prediction model. It comes from having an ironclad methodology and the even more important emotional discipline to follow it without exception. In the interviews that follow, we will break down the philosophy of each legendary trader, one by one. We will explore the critical importance of risk management, the art of cutting losses, the psychology of winning, and the relentless hard work required to achieve greatness. And after every interview, we'll connect that timeless wisdom to the challenges and opportunities you face right now in the 21st century. This is more than a book summary. This is a masterclass in financial thinking. Let's begin. The Wizards of Futures and Currencies. Schwager begins his journey in the fast-moving, highly leveraged world of futures and currencies. These are markets where fortunes can be made and lost in a matter of hours, and they demand a level of discipline that is second to none. Interview 1, Michael Marcus, the first wizard, the timeless principle. The first interview is with a trader who is perhaps the most important and least known of the entire group, Michael Marcus. Operating in near total anonymity, Marcus was rumored to have turned an initial stake of $30,000 into an astonishing $80 million over about a decade. He was a pioneer, a mentor to other wizards like Bruce Kovner, and a living embodiment of the book's core themes. Marcus's story is one of trial, error, and relentless learning. He started as a research analyst, believing in the buy and hold philosophy. His first foray into trading was a disaster. He bought soybean futures, and when the market moved against him, he held on, convinced his fundamental analysis was correct. He held on as the losses mounted until he was completely wiped out. This experience burned a lesson into his soul that would define his entire career. Being right about the fundamentals doesn't matter if the market is moving against you and you don't manage your risk. After this failure, he found a mentor in Ed Seykota, another legendary trader we'll meet later. Seykota was a pioneer of computerized trend-following systems, and he taught Marcus the single most important rule of trading: ride your winners and cut your losers. It sounds simple, but it's the hardest thing to do in practice. Our human nature is to snatch small profits quickly for fear they will disappear, and hold on to losing positions in the hope they will come back to even. Marcus learned to override this faulty programming. Marcus's philosophy can be broken down into a few key principles. The importance of a mentor. He openly states he would have been wiped out for good if not for Ed Seykota. Learning from someone who has already mastered the game can cut years off the learning curve and save you from catastrophic mistakes. You must be contrarian. Marcus believed that the best trades often feel the most uncomfortable at the start. He looked for moments of mass hysteria or deep pessimism to enter a position against the crowd. He famously made a fortune betting on the US dollar to rise when President Reagan was shot believing the market's panic was a massive overreaction. Let the market confirm your thesis. Even if his fundamental view was strong, he would wait for the market's price action to start moving in his direction before committing significant capital. He learned not to fight the tape. Risk management is everything. After his initial wipeout, he became obsessed with risk. He stressed the importance of knowing exactly where you'll get out of trade before you get in. He also advocated for what he called being a pig. When you have a massive winning trade, you press it for all it's worth. His biggest gains came from a very small number of monster trades that he rode for months or even years. This is only possible if you cut the dozens of small losses quickly. Find your own style. While he learned from Kota, he wasn't a pure systems trader. He blended technicals, fundamentals, and market intuition. He emphasized that you can't just copy someone else's method. You have to build one that fits your own personality and temperament. Marcus's story is the perfect introduction. He is the archetypal wizard, a man who failed, learned from his mistakes, found a mentor, developed a philosophy rooted in discipline and risk control, and went on to achieve results that are almost beyond belief. Modern takeaway. Michael Marcus's wisdom is a direct assault on the most dangerous aspects of modern trading culture. Imagine Marcus observing the world of meme stocks in 2021. Thousands of retail traders piled into GameStop or AMC, not based on fundamentals or technicals, but on a narrative of US versus them. As the price skyrocketed, they urged each other to hold the line and never sell. Marcus would see this not as a brave movement, but as a replay of his first disastrous soybean trade on a massive scale. He would recognize the emotional attachment to a position and the complete abandonment of risk management. His rule is clear. If the trade goes against you, you get out. It doesn't matter if you believe in the cause. Your first job is to survive. His emphasis on mentorship is also profoundly relevant. Today, the idea of a mentor has been corrupted by social media gurus selling expensive courses with the promise of easy profits. Marcus's relationship with Kota wasn't about buying a signal service. It was about absorbing a mindset. A true modern mentor isn't someone who gives you stock tips on TikTok. It's someone who teaches you a framework for thinking, who challenges your assumptions, and who helps you build your own robust methodology. Finally, consider his blend of technicals and fundamentals in the context of cryptocurrency. Many crypto purists are fundamentalists. They believe in technology and the long-term vision. Many crypto traders are pure technicians, looking at chart patterns. Marcus would argue that you need both. You can have a strong fundamental belief in a project like Ethereum, but you must still pay attention to the price action. You should wait for the market to show strength before buying, and you must have a predefined stop loss in case a brutal crypto winter arrives. His philosophy provided a balanced, sane approach to a market defined by extreme emotions and narratives. He teaches us that conviction is important, but survival is essential. Interview 2. Bruce Kovner, the global macro philosopher king. The timeless principle. If Michael Marcus was a swashbuckling pioneer, Bruce Kovner is a disciplined, intellectual philosopher king of trading. His story is one of the most compelling in the book because he didn't come from the world of finance. He was a Harvard PhD candidate, a brilliant academic who drove a taxi to make ends meet. He stumbled into trading and discovered that it was the perfect arena for his intellectual curiosity and analytical mind. His results were staggering. For 10 consecutive years, he averaged an 87% annual return. Kovner's interview is less about specific techniques and more about the construction of a professional, institutional-grade trading mindset. He approached the market not as a gambler, but as a risk manager first and foremost. His most famous quote from the book should be etched into the mind of every aspiring trader. My first rule of trading is, don't get caught in a situation in which you can lose a great deal of money for reasons you don't understand. This philosophy was forged in the fire of his early trading. Like Marcus, he blew up his first account. He made a trade in soybean futures, and the price limit down against him multiple days in a row. He was trapped, unable to exit his position as his losses cascaded. The experience was terrifying, but it taught him the most valuable lesson in his life. Before you ever think about how much you can make, you must exhaustively think about every possible way you could lose. Kovner's key principles are a masterclass in professional risk management. Always know you're out. Before entering any trade, he would determine the exact price at which he would exit if the market moved against him. This was not a vague idea. It was a hard stop-loss order placed with his broker. This, he said, was the only way to manage the emotional turmoil of a losing position. The decision was made when he was rational, not in the heat of the moment. Trade small. A common mistake beginners make is trading too large for their account size. Kovner stressed the importance of keeping your position size small enough that any single trade's outcome is emotionally irrelevant. If you are watching every ticket price and feeling your stomach churn, your position is too big. Develop a hypothesis. He never entered a trade just because a chart looked good. He always had a fundamental hypothesis about why the market should move, and then he would use the technicals to determine his entry and exit points. For him, the chart was a confirmation of his thesis and a tool for risk management, not the thesis itself. Accept pain. Kovner is brutally honest about the psychological toll of trading. He says that to be a great trader, you have to be willing to make a fool of yourself and be wrong. Often, you have to take loss after loss and still have the confidence to pull the trigger on the next opportunity. The ability to endure this pain without losing your discipline is what separates a professional from the amateur. Structure and process. His trading operation was not a one-man show. He built a team of analysts and a structured process for generating and evaluating trade ideas. He believed that discretionary trading needed to be grounded in rigorous research and a repeatable process. Kovner's approach is the epitome of treating trading as a serious business. There is no room for ego, hope, or recklessness. It is a game of probabilities and discipline, played by someone with immense intellectual and emotional control. Modern takeaway. Bruce Kovner's philosophy is the ultimate antidote to the gamified, YOLO culture of modern trading apps like Robinhood. The very design of these platforms, confetti animations for trades, easy access to high-risk options, encourages impulsive behavior. Kovner's approach is the polar opposite. He would advise a new trader to write down their hypothesis, their entry price, their stop loss, and their profit target for every single trade before they log into the app. This simple act of planning introduces the discipline that the app's design tries to strip away. His concept of visualizing the worst-case scenario is a powerful tool for navigating the hype cycles of the day. Take the narrative around a visionary company like Tesla. The story of a sustainable energy future is incredibly compelling, but Kovner would force you to ask the hard questions. What if a key executive leaves? What if a competitor makes a technological leap? What if a recession crushes auto demand? By thinking through these negative possibilities, you don't become a pessimist. You become a realist who can set a stop loss at a rational level, protecting yourself if the beautiful story turns sour. Furthermore, his emphasis on trading small is a crucial lesson for the crypto world, where the promise of 100x gains encourages people to make oversized, life-altering bets. Kovner would argue that the more volatile an asset is, the smaller your position size should be. If you want to speculate on a new altcoin, fine, but risk only an amount of money that you can afford to lose entirely without it affecting your financial stability or your sleep. This disciplined approach allows you to stay in the game long enough to catch a major trend, while most others are wiped out by the volatility. Kovner teaches that true courage in trading isn't about making one huge bet. It's about having the discipline to stick to your risk management plan, trade after trade, day after day. Interview 3. Richard Dennis, the Prince of the Pit, the timeless principle. The story of Richard Dennis is the stuff of Wall Street legend. He started as a runner on the floor of the Chicago Mercantile Exchange and reportedly borrowed $1,600, which he turned into an estimated $200 million in about 10 years. He became famous for a legendary bet with his partner, William Eckhart, which led to one of the most famous experiments in trading history, the Turtle Traders. The core of the debate was a classic nature versus nurture question. Are great traders born, or can they be made? Dennis believed they could be made. He argued that trading could be taught as a set of rules, like learning any other craft. Eckhart disagreed, believing that the innate psychological traits were what mattered. To sell the bet, Dennis placed an ad in the Wall Street Journal, recruiting a group of ordinary people, a security guard, a pianist, a Dungeons and Dragons master, and trained them for 2 weeks on his mechanical trend-following system. He then gave them his own money to trade. The results were spectacular. Over the next few years, the turtles, as they came to be called, earned an aggregate profit of over $175 million. Dennis had proven his point. With a robust set of rules and the discipline to follow them, even novices could achieve extraordinary success. The turtle system itself was a straightforward, long-term trend-following strategy. The rules were precise. Systematic entry. They would buy when a market made a new 20-day or 55-day high and sell short when it made a new 20-day or 55-day low. The idea was to catch every major trend. Pyramiding. Once a trade was profitable, they would add the position at predefined intervals, building a large position in a strong trend. This is how they made their colossal profits. Strict risk control. Risk was managed through a simple but effective stop-loss rule based on the market's volatility, using the average true range, or ATR. For any given trade, they would risk no more than 2% of their total account equity. Diversification. They traded a wide variety of markets, commodities, currencies, bonds, to ensure that they would not miss a major trend wherever it might occur. Follow the rules no matter what. This was the most important lesson. Dennis knew the system would go through long periods of small losses, whipsaws, while waiting for a big trend. The key to success was having the mental fortitude to follow the rules mechanically, even when it felt painful or counterintuitive. Dennis's core philosophy was that trading should be as emotionless and systematic as possible. He believed that the biggest enemy to a trader was their own discretion, the temptation to override the system based on a hunch or fear. The turtles' experiment was his ultimate proof that a good system, followed with perfect discipline, could triumph over the market's chaos. Modern takeaway. Richard Dennis's story speaks directly to the modern debate between active, discretionary trading and passive, systematic investing. The turtle system was, in essence, a simple algorithm. In today's world, this philosophy finds its ultimate expression in two areas: quantitative hedge funds and, more accessibly, passive index fund investing. A low-cost S&P 500 index fund is a perfect example of a Dennis-style system for the average person. The rules are simple. Buy the 500 largest U.S. companies, regardless of your opinion about any single one of them, and hold. Don't try to time the market. Don't get scared out by a correction. Just follow the long-term upward trend of the market. This is the essence of the turtle philosophy applied to investing. Trust the system and remove your own destructive emotions from the equation. This is the core strategy of the FIRE movement, and Dennis's experiment provides a powerful intellectual foundation for why it works. For more active traders, the lesson is equally profound. There is a booming industry of AI-based trading and algorithmic strategy development. Dennis would be a huge proponent of this. He would encourage traders to backtest their strategies rigorously, to define their rules for entry, exit, and position size with mathematical precision, and then to let the computer execute the trades. He would argue this is the best way to eliminate the emotional mistakes, the fear and greed that destroy most traders. However, he would also offer a stark warning. The turtles who failed were not those who couldn't understand the rules, but those who couldn't follow them. Some couldn't handle the pain of the inevitable drawdowns and started skipping signals, only to miss the one giant trend that would have made their year. This is a timeless lesson. You can have the best AI trading bot in the world, but if you panic and turn it off during a losing streak, you've defeated its entire purpose. The ultimate edge is not in the complexity of the system, but in the unwavering discipline of the person implementing it. Dennis proved that you can teach a system, but the discipline to follow it must come from within. Interview 4, Paul Tudor Jones, the master contrarianism, the timeless principle. Paul Tudor Jones is one of the most famous and successful traders of all time. His firm, Tudor Investment Corporation, has generated billions in returns. He is most famous for his legendary prediction of the 1987 stock market crash, known as Black Monday, where he reportedly tripled his money in a single day while the rest of the world was in financial meltdown. Schwager's interview with Jones reveals a trader who is an intense, competitive, and deeply intuitive student of market history and psychology. Unlike Richard Dennis, Jones is not a pure systems trader. He is a discretionary macro trader, meaning he makes big bets on the direction of entire markets based on his analysis of economic trends, sentiment, and historical patterns. His entire philosophy is built on a foundation of defense. His office wall famously had a sign that read, "Losers average losers." This means that if you have a losing position, the worst thing you can do is add more money to it, hoping it will come back. Instead, his mantra is, don't be a hero, don't have an ego, always question yourself and your ability. Here are the cornerstones of Paul Tudor Jones's approach. Defense, defense, defense. Before he enters any trade, his first thought is not how much can I make, but where am I getting out? He is obsessed with his stop loss. He says he thinks of every trade in terms of risk, not reward. If he buys something at $100, he might have a stop at $97. His goal is to see if he can find a low-risk entry point, where his potential reward is at least 5 times his potential loss, a 5-to-1 risk-reward ratio. To be a contrarian at the extremes, Jones is a master of fading irrational exuberance and panic pessimism. He looks for moments when the market has gone parabolic, straight up or straight down, and sentiment is at a fever pitch. He believes these are the points of maximum opportunity and lowest risk, because the emotional move has exhausted itself. His 1987 crash call was based on his detailed study of the 1929 crash, where he saw eerie similarities in the price action and speculative fervor. The market moves on emotion. While he does fundamental analysis, he believes that in the short to medium term, markets are driven by human psychology. He is a student of sentiment indicators and tries to gauge the emotional state of the crowd. His goal is to buy when the market is full of fear and sell when it is full of greed. Adapt or die. Jones is adamant that you cannot be rigid in your views. The market is constantly changing, and a strategy that worked last year might not work this year. He says, don't ever feel that you are very good. The second you do, you are dead. He is constantly questioning his own positions and looking for evidence that he is wrong. If the price action goes against his thesis, he doesn't argue with it. He gets out immediately. Paul Tudor Jones is a trading chameleon, blending historical analysis, technical timing, and a deep understanding of market psychology, all wrapped in a layer of paranoid, defense-first risk management. Modern takeaway. The wisdom of Paul Tudor Jones is a perfect roadmap for navigating the extreme sentiment cycles of the modern market. His contrarian philosophy is the ideal tool for dealing with speculative bubbles. Consider the crypto bull run of 2021. As Bitcoin soared towards $69,000, sentiment was euphoric. Social media was filled with predictions of $100,000 or more, and the narrative of digital gold was everywhere. A trader like Jones would have seen this as a signal of a market top. He would not have been buying into the hype. He would have been looking for a low-risk spot to bet on a reversal, or at the very least, taking profits on his existing positions. His 5:1 risk-reward rule would prevent him from ever buying at the peak of a parabolic move where the upside is limited and the downside is catastrophic. His famous losers average losers rule is a direct refutation of the buy-the-dip mentality that can be so dangerous for individual stocks. While buying the dip in a broad market index ETF can be a sound long-term strategy, applying it to a single failing company can be ruinous. Think of investors who kept buying more of a company like Peloton as its stock fell 90% from its highs. They were averaging into a losing position, violating Jones's cardinal rule. He would say the first dip might be an opportunity, but if the stock keeps falling, the market is telling you that you are wrong, and you need to listen. Finally, his focus on adaptability is a crucial lesson for everyone, from day traders to long-term investors. In the last decade, the winning strategy has been to buy and hold U.S. technology and growth stocks. But as Jones warns, what works for one decade may not work for next. An intelligent investor must be open to the idea that the market regime could change. They must be willing to question their own assumptions and not become complacent, always remembering that the market's primary job is to make the majority look foolish. The wizards of stocks. After the high-octane world of futures, Schwager turns his attention to the stock market. Here, the time horizons can be longer and the analysis more focused on the fundamentals of individual businesses. But the psychological challenges remain just as intense. Interview 5. William O'Neill, the growth stock systematizer. The timeless principle. William O'Neill is a towering figure in the world of stock investing. He is the founder of the financial newspaper Investors Business Daily, and the author of the classic book, How to Make Money in Stocks. He is unique among the wizards because he not only achieved tremendous personal success as a trader, but also dedicated his career to creating a systematic, rules-based approach that could be taught to the public. O'Neill's philosophy is a powerful blend of fundamental and technical analysis designed specifically to identify the market's biggest winning stocks before they make their massive moves. He conducted a massive historical study, analyzing the characteristics of every top-performing stock over decades. From this research, he developed his famous cancel methodology. It's an acronym where each letter stands for one of the 7 key traits these super stocks share before their price exploded. C equals current quarterly earnings per share. O'Neill looked for companies with spectacular recent earnings growth, typically at least 25 to 30% higher than the same quarter in the previous year. He wanted to see accelerating growth that A equals annual earnings growth. He demanded a strong track record of growth over the past 5 years, with each year's earnings being higher than the last. N equals new products, new management, new highs. He believed that the greatest stock moves were driven by something new, a revolutionary new product, like the Apple iPhone, a visionary new CEO, or a major change in industry. He also controversially advocated for buying stocks when they broke out to a new 52-week high price, arguing this was a sign of strength, not a time to sell as equal supply and demand. He preferred companies with a smaller number of shares outstanding, as a little bit of buying pressure could have a bigger impact on the stock price. He also looked for signs of large institutional buying, that L equals leader or laggard. O'Neill insisted on buying only the leading stocks in the top-performing industries. He wanted the best of the best, not the cheap, second-rate companies that I equals institutional sponsorship. He wanted to see a reasonable number of well-run mutual funds and institutions owning the stock. This was a vote of confidence from the professionals. However, he was wary if too many institutions owned it, as there would be no one left to buy that M equals market direction. This was perhaps his most important rule. He believed that even the best stock will get crushed in a bear market. He developed a system for identifying the overall trend of the market and would only commit significant capital when the general market was in a confirmed uptrend. 3 out of 4 stocks, he said, follow the market's trend. O'Neill's approach is disciplined, data-driven, and optimistic. He is not a value investor looking for cheap stocks. He is a growth investor looking for the most innovative and dominant companies in the world, and is willing to pay a fair price for that quality. His core rules for selling are just as important. Always cut your losses at 7 to 8%, no exceptions, and sell into strength after a massive run-up. Modern takeaway. William O'Neill's cancel system is arguably more relevant today than when he created it. We live in an age of rapid technological disruption, where a single innovation can create a market leader worth trillions of dollars. O'Neill's method is perfectly designed to identify these hypergrowth companies. Imagine applying the cancel checklist to the FANG stocks, Facebook/Meta, Amazon, Apple, Netflix, Google/Alphabet, in their early growth phases. Each one would have checked every box. Explosive earnings growth, C and A, revolutionary new products and visionary leaders, N, dominance in their respective industries, L, and increasing ownership by institutions, I. His controversial rule of buying stocks at new highs is a direct challenge to the common investor psychology. Most people feel more comfortable buying a stock that has been beaten down, thinking they are getting a bargain. O'Neill proved that, more often than not, this is a mistake. The stocks making new highs are the ones with a powerful momentum and positive story. This is the logic that drives momentum-based ETFs and quantitative strategies today. It teaches you to fish where the fish are, in the strongest stocks in the strongest sectors. However, his system also provides a crucial shield against the dangers of the modern growth stock bubble. Consider the rise and fall of the ARK Innovation ETF, YARKK. During 2020, Cathie Wood's fund soared by investing in disruptive but often unprofitable tech companies. A pure storyteller might have bought and held on all the way down. An O'Neill investor would have been much more disciplined. First, the C and A in cancel demand actual earnings, not just a good story, which would have filtered out many of the more speculative names. Second, and most importantly, O'Neill's ironclad rule of cutting every single loss at 7 to 8% would have protected an investor from the catastrophic 70% plus crash that followed. It's a perfect illustration of his philosophy. Chase dynamic growth, but with an unforgiving, non-negotiable risk management plan. O'Neill teaches us that you can and should invest in the future, but you must have a mechanism to protect yourself in case that future doesn't arrive as planned. Interview 6. Ed Seykota, the original quant. The timeless principle. Ed Seykota is a legendary and highly secretive figure in the trading world, considered by many to be the father of computerized trend-following systems. He was Michael Marcus's mentor and a true pioneer. In the 1970s, when Wall Street was still a world of intuition and gut feel, Seykota was programming early mainframe computers to backtest and trade as mechanical trend-following strategies. He achieved a level of success that is almost incomprehensible, with one of his client accounts reportedly returning 250,000% over a 16-year period. Schwager's interview with Seykota is unique because Seykota is as much psychologist and philosopher as he is a trader. He believes that the market is a psychological arena, and that success comes from understanding both the crowd's emotions and, more importantly, your own. His famous quote captures his entire philosophy. Win or lose, everybody gets what they want out of the market. What does this mean? Seykota believes that some people subconsciously want to lose. They trade for the thrill of the action, to prove they are right, or to self-sabotage. If you are not in tune with your own emotions and motivations, you'll find a way to lose, regardless of how good your system is. The market will give you exactly what you are subconsciously looking for. Seykota's core trading principles are elegant and simple, reflecting his systematic approach. The trend is your friend. His systems were designed to do one thing: identify a trend and ride it for all it was worth. He believed that trying to predict tops and bottoms was a fool's errand. The big money is made in the middle of a major, sustained move. Cut losses. This is a mantra of nearly every wizard, but Seykota's take is absolute. A losing trade is a signal that your analysis is wrong, and you must act on that signal immediately and without emotion. Let winners run. He was fanatical about not cutting his profits short. If a market was trending strongly in his favor, he would stay with it, even if it meant giving back a significant portion of profits from the peak. He knew that the biggest gains came from riding a trend far beyond what seemed reasonable. Manage risk. Like Dennis, he used precise rules for position sizing based on account equity and market volatility to ensure that no single trade could ever knock him out of the game. Follow the rules. For Seykota, a trading system was a contract with yourself. The only way it could work was if you followed it with 100% fidelity. Any deviation introduced emotion and ego, the two great destroyers of trading accounts. Beyond the trading rules, Seykota was deeply interested in trading psychology. He believed that traders had to work on themselves as much as they worked on their systems. They had to learn to accept randomness, to be comfortable with uncertainty, and to detach their self-worth from the outcome of any single trade. Modern takeaway. Ed Seykota's ideas are the intellectual foundation for the entire multi-trillion-dollar industry of quantitative and algorithmic trading. Hedge funds like Renaissance Technologies and Two Sigma are the modern descendants of Seykota's early computer models, using immense computational power to run sophisticated trend-following and statistical arbitrage strategies. For the individual investor, his philosophy is best embodied by the rise of smart beta and factor-based ETFs. Funds that focus on factors like momentum are essentially packaged versions of Seykota's core idea: systematically buy what is going up and sell what is going down. His psychological insights, however, are his most enduring legacy. His statement that everybody gets what they want out of the market is a chillingly accurate description of the behavior seen on forums like Reddit's Wall Street Bets. While some are there to make money, many are clearly there for the excitement, the sense of community, and the thrill of gambling. They get the adrenaline rush they're looking for, but often at the cost of their capital. Seykota would argue that until a person confronts their true motivations, they are doomed to repeat a cycle of boom and bust. Consider the psychology of a crypto hodler, a term derived from a misspelling of hold, meaning to hold on for dear life. This strategy, while it can work in a long-term bull market, often stems from a psychological inability to accept a loss. A trader who bought Bitcoin at $60,000 and watches it fall to $20,000 might tell themselves they're a long-term investor with strong conviction. Seykota would challenge him to ask, are you holding because your system tells you the long-term trend is intact, Or are you holding because you are emotionally incapable of realizing a 65% loss? His philosophy forces a level of radical self-honesty that is rare in the investment world. It teaches us that the market is a mirror. It reflects your own psychological flaws back at you with a price tag attached. To win at the market, you must first win the battle within yourself. Interview 7, Larry Hite, the risk manager's risk manager. The timeless principle. Larry Hite is not the most famous trader in Market Wizards, but his interview might be the most practical and important for the average person. Hite co-founded Mint Investment Management Company, one of the first and most successful quantitative hedge funds, or commodity trading advisors, CTAs. He approached the market not as an artist or predictor, but as a statistician and an odds maker. His entire worldview is based on one simple, powerful idea. I don't trade markets, I trade risk. Hite's background was not in finance. He was a rock promoter and an actor. He came to trading with a fresh perspective. He saw the market as a casino, but one where, if you were smart, you could be the house, not the player. He wasn't interested in being right or predicting the future. He was only interested in putting the odds in his favor and then managing his risk so relentlessly that he could never be knocked out of the game. His philosophy is one of profound humility. He says, "We are not in the business of being right. We are in the business of making money. And to do that, you have to be able to admit you are wrong." His approach, which was fully computerized, was built on a few unbreakable rules. The absolute primacy of risk control. Hite's number one rule was to never risk more than 1% of total account equity on any single trade. This meant that he could be wrong 10, 20, even 30 times in a row and still be in the game, waiting for the one big winning trade that would pay for all the small losses. This is a mathematical core of his success. Follow the trend. Like, say, Coda and Dennis, Mint systems were designed to be trend followers. Hite believed that trying to pick tops and bottoms was an exercise in ego. It was much more profitable to simply identify the direction of the market and ride along with it. Diversify widely. Mint traded in dozens of markets all over the world. Hite knew he couldn't predict which market would have the next big trend, so he placed small bets on all of them. This diversification ensured he would always have a hook in the water, ready to catch the big one. Embrace the asymmetry. The entire philosophy is based on a simple mathematical truth. Your losses are capped at 1%, but your potential profits are unlimited. By cutting losses small and letting winners run, you create a positive asymmetry. The average winning trade is many times larger than the average losing trade, so you could be right less than 50% of the time and still be phenomenally profitable. Larry Hite is the ultimate pragmatist. He removes ego, prediction, and emotion from the equation entirely, reducing trading to a simple, repeatable game of statistics and risk management. Modern takeaway. Larry Hite's philosophy is the intellectual backbone of a sound, modern financial life. While he was running a sophisticated hedge fund, his core principles are perfectly applicable to the average person trying to build wealth. His number one rule, never risk more than 1% on one idea, is a powerful guideline for anyone tempted to speculate. If you have a $50,000 portfolio and want to buy a speculative meme stock or a new altcoin, Hite's rule would tell you not to invest more than $500. This allows you to participate in potential upside without ever risking catastrophic loss. It is the perfect mathematical antidote to the all-in YOLO trade. His belief in systematic, unemotional investing finds its modern parallel in the world of robo-advisors. Services like Betterment and Wealthfront are essentially Larry Hite's philosophy packaged for the masses. They create a globally diversified portfolio of low-cost ETFs based on your risk tolerance, and then use algorithms to rebalance and manage it. The entire process is systematic, removing your own emotional biases from the day-to-day decisions. It's a strategy built on diversification and risk control, not on trying to predict the next hot stock. Furthermore, Hite's view of the market provides a healthy dose of realism for anyone pursuing financial independence. Retire early FIRE. The FIRE journey is a long-term trend following exercise. It requires patiently and consistently investing over decades. But there will be bear markets and crashes along the way. These are the equivalent of Hite's small, unavoidable losses. His philosophy teaches you to accept them as part of the process. as long as your risk is managed, meaning you aren't over-leveraged and you have an emergency fund so you don't have to sell at the bottom. You can weather these downturns and stay in the game long enough for the powerful long-term upward trend of the market to reassert itself. Larry Hite teaches us that you don't have to be a genius to get rich. You just have to be a survivor at a view from the floor and beyond. In the next section, Schwager talks to traders with different perspectives, including those who started in the chaos of the trading pits and those with a truly global, long-term view. Interview 8, Marty Buzzy Schwartz, the champion trader. The timeless principle. Marty Schwartz's story is one of incredible transformation. For nearly a decade, he struggled as a fundamental stock analyst. He worked hard, he was smart, but he was consistently losing money. He was on the verge of quitting, having mortgaged his house and depleted his savings. Then, he had an epiphany that changed his life and made him a legend. He realized that his ego, his need to be right in his fundamental analysis, was destroying him. He decided to abandon his old approach and become a pure technical trader, focusing only on what the price and volume were telling him. The change was immediate and dramatic. He entered a national trading championship and earned the nickname Buzzy for his incredible success, achieving returns that seemed impossible. His core realization was this: my biggest discovery was that you have to find a method that fits your own personality. As a fundamental analyst, he was miserable and unsuccessful. As a technically driven, short-term trader, he felt at home and thrived. Schwartz's approach is that of a blue-collar, hard-working warrior. He is not a cool, detached intellectual like Kovner. He is a fighter who scraps for every dollar. His key principles are a blend of technical analysis and intense mental preparation. Listen to the market, not your ego. His biggest breakthrough was separating his self-worth from his market opinions. He learned to subordinate his own fundamental view to what the market was actually doing. If he thought a stock should go up but the tape was moving down, he trusted the tape, not his ego. The importance of process. Before the market opened each day, Schwartz would do his homework. He would analyze his charts, identify key support and resistance levels, and map out his plan for the day. He believed that preparation was the key to success. Manage your emotional state. Schwartz is brutally honest about the psychological grind of trading. He talks about the importance of physical health, getting enough sleep, and managing stress. He knew that if he was not in a peak emotional and physical state, he was more likely to make costly mistakes. He treated himself like a professional athlete preparing for a big game. The moving average is key. One of his primary technical tools was the simple moving average. He tried to stay on the right side of the moving average to ensure he was trading with the prevailing short-term trend. Increase size when you're winning, decrease when losing. This is a crucial counterintuitive rule. Most traders, after a big loss, feel the need to win it back and increase their size. After a big win, they get scared and trade smaller. Schwartz did the exact opposite. When he was trading well and in sync with the market, he would press his bets. When he was in a slump, he would cut his size way down, preserving his capital until his performance improved. Marty Schwartz's story is a powerful testament to the idea of finding your niche and the importance of psychological and emotional management in peak performance. Modern takeaway. Marty Schwartz's journey of transformation from a failing analyst to a champion trader is a perfect allegory for the modern retail investor trying to find their way. Many people start by trying to be a stock picker, an amateur fundamental analyst. They read a few articles, believe in a company's story, and buy the stock. But as Schwartz discovered, this is an incredibly difficult game to win without a real edge. His switch to technical analysis is symbolic. For many modern investors, the parallel switch might be from trying to pick individual stocks to adopting a simple, systematic, passive ETF strategy. It's an admission that the first approach doesn't fit their personality, time commitment, or skill set, and that a different, more disciplined method is required. His principle of increasing size when winning and decreasing when losing is a profound lesson in money management. Think about the psychology of the Robin Hood trader. After a few lucky wins on options or meme stocks, they often feel invincible and dramatically increase their bet size, leading to a catastrophic blow-up. Conversely, after a market crash, they are too scared to invest their regular monthly contribution. Schwartz's method would have them do the opposite. Add more capital after a period of success, a rising market, and be more cautious and invest less or just their normal amount during a losing streak, a bear market. It's a dynamic form of risk control that protects you from your own overconfidence and fear. Finally, his focus on treating himself like a professional athlete is a vital lesson in our hyperconnected, 24/7 world. It's easy to get caught up in the constant stream of financial news, checking your portfolio every 5 minutes, and making emotional decisions based on a tweet. Schwartz's discipline preparing before the market opens and then managing his emotional state during the day is a call to action. It urges us to set aside specific times to review our finances, to have a clear plan, and most importantly, to step away from the screen to avoid making impulsive, fear, or greed-driven mistakes. In an age of information overload, managing your own focus and emotional energy is the ultimate edge. Interview 9, Jim Rogers, the adventuring investor, the timeless principle. Jim Rogers is not a trader in the traditional sense. He is a grand-scale investor and a student of history, economics, and culture. Along with George Soros, he co-founded the legendary Quantum Fund, which was one of the first truly global macro hedge funds. The fund was spectacularly successful, reportedly generating a return of over 4,000% in a decade, while the S&P 500 returned less than 50%. Schwager's interview with Rogers reveals a man with boundless curiosity and a fiercely independent, contrarian mind. Rogers' approach is not about reading charts or watching a ticker tape. It's about understanding the deep, slow-moving, fundamental currents of the world. He believes that the best investment ideas are not found on Wall Street, but by traveling the world and seeing things for yourself. He famously drove a motorcycle around the globe to get a ground-level view of emerging economies. His philosophy is built on patience, deep research, and the courage to be a true contrarian. Do your own research. Rogers is deeply skeptical of Wall Street consensus. He believed that most analysts are just part of herd and that their research is often shallow and biased. He insists on doing his own primary research, whether it's studying the supply and demand dynamics of commodity like copper or visiting a country to gauge its economic health firsthand. Wait for a bargain. Rogers is a value investor at his core. He says the key to his success is waiting until there is money lie on the floor, and all I have to do is go over there and pick it up. He looks for situations where an entire country or an entire asset class is universally hated, written off, and trading at a massive discount to its intrinsic value. He bought into Austria and Germany when people thought they were basket cases and made a fortune. Patience is everything. Rogers is willing to wait for years for the right opportunity to emerge. And once he buys, he is willing to hold for years, waiting for his thesis to play out. He is the polar opposite of a short-term trader. He believes that most people lose money by constantly flitting from one idea to the next, be a contrarian realist. He loves to bet against the crowd, but only when his fundamental analysis tells him the crowd is wrong. He is not a contrarian for the sake of being different. He is a contrarian because his independent research has led him to a conclusion that is at odds with the popular narrative. Understand the big picture. His entire approach is top-down. He studies politics, history, and demographics to understand which way the world is moving, and then he finds assets that will benefit from those long-term trends. Jim Rogers is an intellectual adventurer, a man who combines the diligence of a historian with the courage of an explorer to make huge, long-term bets on the future of nations and economies. Modern takeaway. Jim Rogers' philosophy offers a powerful long-term perspective that is desperately needed in our short-term obsessed world. His insistence on doing your own deep research is a direct challenge to the modern culture of getting investment ideas from social media. Buying a stock or a cryptocurrency because it's trending on Twitter or being hyped by an influencer is the exact opposite of the Rogers approach. He would urge investors to turn off the noise, read history books, study annual reports, and form their own independent view of the world. His strategy of waiting for money lying on the floor is a timeless value investing principle. Think about the market sentiment during the depths of the COVID-19 crash in March 2020. The world was gripped by fear. Entire industries like airlines and hospitality were being priced as if they were going out of business forever. This was a classic Rogers moment. Panic and despair were universal. An investor with his mindset would have been calmly analyzing balance sheets to see which companies could survive the downturn, knowing they were being offered incredible long-term bargains. While everyone else was panicking, he would have been picking up the money that was lying on the floor. Furthermore, his global perspective is more important than ever. Many investors, particularly in the U.S., suffer from home country bias, investing only in their domestic stock market. Rogers' entire career is a testament to the opportunities that can be found by looking abroad. A modern Rogers-style investor might be studying the demographics of Southeast Asia, the commodity resources of South America, or the technological development in certain European sectors. Using globally diversified ETFs is a simple way for the average person to implement this worldview, ensuring they have exposure to long-term growth trends wherever they may occur. Jim Rogers teaches us to lift our eyes from the day-to-day noise of the market and to invest in the grand, unfolding story of the world, the modern wizards of a new era. The final sections of the book bring in traders who are active in a more modern, technologically advanced market, but whose principles echo the timeless wisdom of the original wizards. This synthesis of old and new provide a powerful conclusion to Schwager's work. Synthesizing wisdom, the core principles. As we step back from the individual interviews, a clear picture emerges. Despite their wildly different styles, the market wizards all climb the same mountain, just from different sides. They all arrived at a set of fundamental truths about the market, and more importantly, about themselves. These truths are the book's ultimate treasure. A method is essential, but the specific method is not. Some were technical, some fundamental, some systematic, some discretionary. The critical lesson is that they all had a method. They had a philosophy and a process that they believed in and had tested. They weren't just guessing. Risk management is job number one. This is the single biggest common denominator. Every single wizard, without exception, was obsessed with managing risk. Whether it was Paul Tudor Jones thinking about a stop loss before his entry, or Larry Height's 1% rule, they all knew that success was not about hitting home runs. It was about never letting a loss sink your ship. Capital preservation is the foundation of all long-term success. Discipline is a true holy grail. You can have the best system in the world, but if you don't have the discipline to follow it, it's worthless. The wizards all spoke of the psychological battle to stick to their plan, especially during periods of losses. This emotional fortitude is what separates the 1% from the 99%. Hard work is non-negotiable. None of these traders were lucky amateurs. They were incredibly hard workers who dedicated their lives to mastering their craft. Whether it was O'Neill studying historical stock charts or Rogers traveling the world, they all put in thousands of hours of research and preparation. There are no shortcuts. Flexibility and humility are survival traits. The wizards had strong convictions, but they were not rigid. They were constantly questioning themselves and were ready to admit they were wrong in a heartbeat. The market is the ultimate arbiter, and ego is a direct path to ruin. As Paul Tudor Jones said, the moment you think you're a genius, you're dead. These are not just trading tips. They are a blueprint for a mindset. It is a mindset of extreme ownership, radical self-honesty, and profound respect for the power of the market. Modern context expansion. What would the wizards say today? If we could assemble the market wizards in a room today and show them our modern financial world, what would they think? They would be stunned by the technology, but they would instantly recognize the timeless human behaviors driving it all. They would be both deeply concerned and, in a strange way, optimistic about the opportunities. The tools of the trade, Robinhood, AI, and social media. First, the wizards would be amazed by the democratization of market access. The idea that anyone could trade global markets from a phone with zero commission would be astonishing. But their amazement would quickly turn to alarm. They would look at an app like Robinhood and see a brilliantly designed machine for encouraging the worst possible human behaviors. The gamification, the prompts to trade options, the focus on hot stocks. They would see it as a system designed to churn accounts and prey on the uninformed. They would argue that while access has been democratized, education and discipline have not. They would be divided but fascinated by AI-based investing and quantitative models. The quants like, say, Coda, Dennis, and Haidt would see it as the ultimate evolution of their work. They would embrace the ability to backtest complex strategies on vast datasets and execute them with perfect, machine-like discipline. They would likely be running their own AI-driven hedge funds. However, the more discretionary traders like Paul Tudor Jones and Bruce Kovner would be more skeptical. They would argue that markets are not pure mathematical systems. They are driven by human psychology, which can be irrational and unpredictable. They would warn that any AI model trained on past data is vulnerable to a black swan event, a crisis that looks nothing like the past. They would argue that in moments of true panic or euphoria, human intuition and the ability to read the emotional temperature of the market are irreplaceable. All of them would be horrified by the rise of social media as a primary source of investment ideas. The idea of buying a stock based on a Reddit post or a TikTok video will be anathema to their core principle of independent thought and deep research. They would see it as the ultimate herd behavior, a digital mob that is almost always destined to be fleeced by more disciplined, professional players. They would argue that social media amplifies the very emotions, FOMO and panic, that they all spent their careers learning to control. The modern strategies, index funds versus day trading. The Wizards' philosophies provide a powerful lens for evaluating the dominant strategies of our time. Their reaction to index funds would likely be one of universal, if grudging, respect. For the 99% of the population that does not have the time, skill, or emotional temperament to be a professional trader, they would almost certainly agree that a low-cost, diversified index fund is the most rational and effective path to building wealth. It embodies their core principles. Risk management. It's inherently diversified. Discipline. It requires a simple, repeatable plan of buying and holding no ego. It's an admission that you cannot beat the market, so you choose to own the market. Trend following. It is a bet on the long-term upward trend of corporate earnings and human ingenuity. The Wizards would see index funds as a perfect solution for playing a game that most people are not equipped to win. On the other hand, they would view the modern culture of day trading with a mixture of pity and contempt. They would see it as a negative-sum game, where commission-free apps lure people into a high-frequency casino. They would recognize that the short-term noise of the market is mostly random, and that trying to scalp tiny profits is a battle against high-frequency trading firms and market makers who have a massive technological and informational edge. They would point to their own experiences. Even they, the greatest traders in history, made their fortunes on a small number of large, multi-day or multi-month trends, not by day trading the 5-minute chart. They would argue that modern-day trading is not investing. It is a dopamine-fueled form of entertainment with a very high ticket price. Timeless principles as a shield against modern risks. In a world of information overload and constant stimulation, the Wizards' core principles are not relics. They are more essential than ever. They are the psychological shield we need to survive. Risk management as an antidote to FOMO. When you see a cryptocurrency up 500% in a month, the fear of missing out is overwhelming. A Wizard's mindset forces you to stop and ask, if I buy here, where's my stop loss? How much am I willing to risk? This simple question can be the difference between a small, manageable loss and a devastating blow-up. Discipline as a defense against gamification. Modern trading apps are designed to make you act. A Wizard's discipline is about having a plan and not acting unless the market meets your predefined criteria. It's the power of patience in a world that demands speed. Independent thought is a shield against a herd. Social media creates powerful echo chambers and narrative bubbles. The Wizards teach us to be skeptics, to do our own work, and have the courage to stand apart from the crowd, knowing that the biggest opportunities are often found where no one else is looking. The Wizards will conclude that while the market's tools have evolved from hand-drawn charts to quantum computers, the game remains the same because the players, human beings, remain the same. The modern world has simply created more powerful and efficient ways for people to make the same old mistakes. The discipline they taught is not just relevant, it is the only path to survival. Closing reflection, 10 timeless lessons from the market wizards. As we conclude our journey through Jack Schwager's masterpiece, we are left with a collection of mental models that are as powerful and practical today as they were in the 1980s. This is not a get-rich-quick scheme, but a timeless guide to thinking, surviving, and ultimately thriving in the world of finance. Let's distill this profound wisdom into 10 timeless lessons. There is no holy grail. The first and most important lesson is that there is no single magic formula for the markets. The wizards were all different. The path to success is not about finding the perfect indicator, but about building a complete methodology that fits you. Master risk before you seek reward. The one trait every single wizard shared was an obsession with risk management and capital preservation. They knew that the secret to winning was to first ensure you never lose big. Your number one job is not to make money. It's to stay in the game. Discipline is your ultimate edge. The market is a battle against your own worst instincts. A great method is useless without the iron will to follow its rules, especially when you're scared or greedy. Success is a function of your discipline, not your intelligence. Cut your losses without hesitation. Every wizard agreed. You must be ruthless in cutting losing trades. A small loss is a healthy part of the business. A large loss can be a career-ending event. Do not hope, do not rationalize, do not average down. Just get out. Let your winners run. This is the other side of cutting losses. It is psychologically difficult, but the greatest profits come from riding a few major trends for far longer than seems comfortable. Don't snatch small profits. Have the patience to let a good idea truly work to your homework. Luck is not a strategy. The wizards were relentless in their research and preparation. Whether you are analyzing charts, economic data, or company fundamentals, thorough and independent work is the only way to develop a real edge. Humility is a superpower. The market loves the humble, the arrogant. The wizards were confident in their abilities, but had zero ego when it came to their trades. They were always willing to admit they were wrong and change their minds in an instant. Think for yourself. The consensus is almost always wrong at major turning points. The greatest opportunities are found in places that are unpopular, ignored, or feared. You will never achieve superior results by following the herd. Patience is profit. The market pays you to wait. Wait for the right trade setup. Wait for the money to be lying on the floor. And once you are in a winning trade, have the patience to let it mature. Most of the time, the best action is no action at all. It's a marathon, not a sprint. All the wizards viewed their careers in terms of decades, not days. They knew there would be losing days, losing weeks, and even losing years. Their focus was on a sound process that, over the long run, would yield positive results. So, how can you, the average investor, apply these powerful lessons right now? It does not mean you should quit your job and become a day trader. In fact, it means the opposite. It means applying the wizard's professional mindset to your own personal finances. Start by defining your goals and your risk tolerance. Create a simple, robust investment plan. For the vast majority of people, this will be a portfolio of low-cost, globally diversified stock and bond index funds. This simple strategy embodies the wisdom of the wizards. It is a systematic, rules-based approach, the wisdom of Dennis and Seikoda. It is built on diversification and long-term trend following. It requires the discipline to stick with a plan during downturns, cutting your emotional losses, the wisdom of all the wizards. Then commit to that plan. Automate your contributions every month, a strategy known as dollar cost averaging. This forces you to buy consistently, whether the market is high or low, removing the fatal temptation of trying to time the market. You are executing a simple, proven system with discipline. Finally, dedicate yourself to understanding your own psychology. Notice when you feel greedy after the market has gone up or fearful after it has fallen. By recognizing these emotions, you can avoid acting on them. The wisdom of the market wizards is not about becoming a trading genius. It's about building a fortress of discipline and process that protects you from the emotional chaos of the market and, more importantly, from yourself. Schwager's path is not easy. It's a path of relentless work, self-awareness, and humility, but it is the only reliable path to long-term success in the financial markets. It teaches you that the ultimate goal is not to have a perfect track record, but to have a sound process that allows you to survive, adapt, and prosper over a lifetime. That is the true wisdom of the market wizards.